What's up everyone, it's Caddy with MoneyVest. So in this video, we are going to be talking about Walgreens, the demise of Walgreens. So I'm going to break down everything you need to know about this company and why it's been selling off. It's been significant underperformer year to date. Ross Brewer, who was a CEO at Starbucks and a former CEO at Walmart, stepped down recently and the stock continued on its sell-off even further. So we're going to talk a lot about Walgreens in this video. We're going to do some comparisons to CVS as well, and then I'll break down what my thoughts are and what the path looks like for Walgreens moving forward, say next 3 to 5 years. I'm not going to be doing a calculation in this video, intrinsic value wise, because the predictability with respect to earnings and free cash flow is uncertain. There's no management there. So it's going to take some time for us to kind of stabilize and better understand what Walgreens' business is going to look like 5 years from now. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel, and link to our Discord and Patreon is going to be down below. The first week of the month is the best time to join. We'd love to have you on board as a MoneyVest member, and you get access to all the alerts, all the updates, members only videos, intrinsic value spreadsheets. Everything's going to be included with the link down below. So this right here is what Walgreens has been doing. Damaging our portfolios. That's what it's been doing. So down almost 40%. On a year-to-date basis, so significant underperformance compared to the S&P 500, which is up about 17.5%. This right here is in the last 3 years. So what we will notice is that up until January of 2022, Walgreens was actually outperforming the S&P 500. So we were seeing a very nice 49 to 50% move. And a lot of that came in due to the increase in demand with respect to testing kits, vaccines, and this was a time when the profits and revenues were doing far better than right now. So there was a little bit of a seasonality spike, if you want to call it, but something that was a one-off event, something that's not going to go on forever, similar to what we have witnessed for a lot of companies, right? Take Zoom, for example, take Zim Integrated Shipping, for example, take Upstart, for example. A lot of these companies that had these one-off events during the pandemic that resulted in their revenues and profits to spike pretty significantly. And now that the businesses have normalized, the growth is no longer there. And same things happened with Walgreens, that ever since 2022, the stock price has been on a consistent decline, and the revenue growth and earnings growth has also pulled back substantially. Now, when you see headlines like these, right, it's never good. Walgreens is closing 450 locations. Walgreens is closing 100 plus locations in the US. And this right here from the street, Walgreens is closing 150 stores. Everyone should worry. So I'll break down, some very simple basic facts, 101, why it's so difficult. There are two really hardest things when it comes to business. We'll talk about that. And then also break down the pathway to profitability, to back to normalization for Walgreens moving forward. Now, I do think that the CEO basically stepping down, Ross Brewer, who has been a part of Walgreens since 2021, is a good thing, and I'll get to that in just a minute. Now, before we get any further, I do want to point out though that this is not Walgreens specific, right? Even though yes, there are catalysts, there are specific headlines that I just showed you guys that Walgreens, closing down 450 locations. I mean, that's just tip of the iceberg. We already know that the CEO has stepped down. That basically came out earlier this week, or I think last week, but even though we've got Walgreens specific catalysts, the sector overall, which I consider to be pharmaceutical, healthcare, retailers, are under pressure in 2023. They are overall. I mean, you can take a look at CVS. CVS is also almost same price action as Walgreens, down 34% in the last 1 year compared to the S&P 500. Year to date, it is down 30%. So the overall sector is down. And that additional 10% that Walgreens is down is based off of what the company specifically is doing with shutting down its stores, not generating free cash flow, and of course the CEO stepping down. So just want to be very clear that this is not specific to Walgreens. Yes, there are catalysts that are making it more challenging for Walgreens right now, and the stock price is down more than CVS, but overall the sector is down with a few exceptions. So this right here, Target, I put these in the same category because you can walk into Target, you can walk into Walmart, you can basically buy almost the same products from these companies. The only difference is that CVS, Walgreens have a little bit of a more sort of healthcare and pharmaceutical dynamics to it, as opposed to Target and Walmart that are more like proper retailers that you can basically buy a lot of different things, right? There's also groceries, there's also perishable items, there's electronics, there's a lot of things that you can buy from Target and Walmart that you can't with CVS and Walgreens. But to give you a little bit of an understanding of the overall retail sector and how it's been selling off and underperforming year to date. So Target's down 17.5%. Walmart is a bit of an exception, so it is up over 11.6%, still underperforming the S&P though, but positive on the year nonetheless. And CVS and Walgreens definitely just selling off aggressively, Walgreens being the biggest underperformer, down almost 40%. So now that we've established that, right, what does Walgreens really do? Walgreens healthcare, retail, pharmacy sales operates through following segments. We got the U.S. retail pharmacy, international. It's got a lot of presence in the U.K. as well. And the U.S. retail pharmacy segment includes the operation of retail drugstores, health and wellness, specialty and home delivery pharmacy services, and equity method investment. The international segment offers pharmacy-led health and beauty retail outside the US and pharmaceutical wholesaling distribution businesses in Germany and of course in the UK as well. Looks like there has been an interim CEO now, Ginger Graham or Ginger Graham. I don't want to mispronounce the first name, but they have stepped in. He has stepped in the interim as they are looking for a new CEO. And the dividend yield, of course, has jumped to over 8.45% as the price has continued to come down because they do pay a dividend of about $1.90, almost $3, actually $2 per share, and price is at right now $22. So if you do the math of 190 divided by 2250, we're looking at 8.44% in dividend yield, which again is pretty substantial. And one more thing that I want to point out is that dividend, obviously there is uncertainty around that dividend, and is that dividend going to stay or if that's going to get cut. Now, Walgreens is known for being a dividend aristocrat, right? For those of you who don't know, a dividend aristocrat is basically a company that has consistently grown its dividends for many, many years. So with 47 years of consistent dividend increases, Walgreens has been paying dividends to shareholders for a very, very long time, and it is a dividend aristocrat and is nearly a dividend king. And the corporation has a long streak of paying dividends, yet its distributions have been highly consistent despite that. So that's the thing. And then since 2012, the payout has increased from 90 cents to $1.92, and that's a compounded annual growth rate of 7.9%. Now, is a dividend cut coming for the first time ever? And is a dividend decrease coming for the first time? Short answer, I don't know. Long answer, I can speculate. Now, given that the payout ratio for Walgreens at the moment, and let's face it, Walgreens is not a growth stock. Most people that are holding Walgreens are holding for the dividend, right? It's a dividend stock, right? Same as CVS. CVS got maybe like a little bit of growth / dividend, but Walgreens, for the most part, people investing in Walgreens, at least what I believe it to be, is because of dividends, right? You're not investing in Walgreens to have a lot of growth in capital gains, right? That's a plus, that's an addition, that's a benefit, cherry on top, but for the most part, it's the dividend. So the moment a dividend cut happens, and I think the board knows that, if there is going to be a dividend cut, you're going to see a pretty dramatic sell-off in the price even further. Wouldn't be surprised if it ends up trading below $20, right? Because right now, everyone's really looking at that dividend yield and whether that's going to get cut or not. Now, if you come over to the payout ratio, which is basically telling us what percentage of earnings are being paid out in dividends, the payout ratio 38% as of 2022 on EPS of about $1.91. And we'll get to some of the more business and structural problems about Walgreens here in just a minute. But $1.91, and the dividend yield on a forward basis, 5.45%, and that's obviously jumped to over 8.45% because of the lower price, so that's not accounted for. One thing I will point out is that 38% is the payout ratio. You click on this question mark, it'll tell you it's basically a payout ratio paid to shareholders relative to the company's net profit, right? The actual earnings. And company Walgreens has basically guided us that their EPS is going to be somewhere between $4 and $4.10 per share. So $4 to $4.10 per share. So if you do the math now, the updated math for the company, $1.90, let's just say the dividend next year grows by 5%. So we're looking at $9.95. Let's just call it $2. $2 divided by 4, which is going to be that EPS, that's a 50% payout ratio. So I assume this ratio is going to go up from 38% to over 50%, if not more, if the dividend doesn't get cut or if there's no decreases, which 50% is still reasonable. Like the company can manage to do that as long as their core business stabilizes a little bit and the profitability is still decent enough at 2.5% margins, and EPS is going to be exactly what they told us, which is about $4. So this right here is obviously the CEO Ross Brewer stepping down. So the abrupt exit and the decision, quote, was mutually agreed, and it's never mutual, right? Regardless of what anyone tells you, it's never mutual. Upon by Brewer and Walgreens' board, the company said Brewer, who had been in the job for less than 3 years, I think she took on in 2021, basically had the same language on a LinkedIn post. And she says, and I quote, "This is perhaps one of the most difficult notes I've ever written over the course of my career." And of course, she is stepping down and is no longer part of the board, effective the day before August 31st as well. So very, very quick action. They had to, basically, this is not something that, again, you do and then you just like get rid of, don't remember it. It's something that was already pre-planned, and it's just an announcement type day on the day that she left, and there was no sort of like grace period, and it was effective immediately. That's how much the board is not happy with how things were running. It tells you a little bit about, the direction of the company was not what the board wanted, and of course the stock price reflected that in the market very much. So there's two things that are really hard in the business world, which Walgreens seems to be struggling with. Number one, executing to profitability, right? The company's already done. Okay, they were profitable. They were doing some decent margins. I'll get to the profitability in just a minute. So, if you come over here, they have been on a statement basis, on an annual basis, what you will notice that they have been able to consistently be stable in terms of those revenues. So again, 130 billion, they're doing 140 billion each year, and they're doing about, $2 to $4 billion in profits every single year. So it's not like a failing business, right? A lot of people think that Walgreens is absolutely failing, right? If you take a look at the numbers, the net income is stable, right? I mean, it's not growing by no means. It's not really going up, but it's stable to a point where it's $3 to $4 billion, right? And total revenue has been about $130 billion. The problem happens when a company like Walgreens wants to grow, right? The problem happens when companies like Walgreens and CVS want to grow their revenues and profits, right? I mean, this is stable. This is core business, which is strong. Problem happens when they start looking at opportunities to grow the business, and they do that by sacrificing their core business, okay? And that is the hardest thing to do in the business, is pivoting to more profitability by doing things, by investing, and by doing acquisitions. And that's really, what, in my opinion, has led to Walgreens getting to this point, because their free cash flow and their net debt are going in opposite directions. So the main issue with Walgreens has been free cash flow, which I'll get to in just a minute. But this right here is the full year guidance and the earnings from 4 to 4.05 per share. That's down from 4.45 and 4.65. So a little bit of a cut in their full year guidance for EPS. And they basically mentioned that challenging consumer and macroeconomic conditions and lower COVID-19 vaccines and testing volumes. Our revised guidance takes a proprietary cautious forward view in light of consumer spending uncertainty, while still demonstrating clear drivers of a return to operating growth next fiscal year, is what Ross Brewer said before she left. And they also mentioned that they're increasing their cost-saving efforts to $4.1 billion, taking immediate actions to optimize profitability for our U.S. healthcare segment, which is good. And I'm confident that our turnaround strategy positions Walgreens to drive sustainable core growth and deliver long-term shareholder value as well. Now, this right here are pretty good numbers. Again, they did grow 4.4% year over year for pharmacy sales in the U.S. Pharmacy sales overall grew 6.3%. Comparable pharmacy sales up 9.8%, boosted by higher prices by branded medication. This is all as of June quarter, right? This was released in June 2023, so very recently. Of course, the profit cut, slashing full year outlook. We've got the competition from other brands, and then not to mention Ross Brewer stepping down. A lot of these catalysts playing a big role in the sell-off in Walgreens that we're witnessing. Now, this right here is the cash flow problem. Okay. Now, Walgreens, Boots Alliance, and Village MD have 52 co-located primary care practices, because as we know that Walgreens was making a huge transition away from its main core business, pharmaceutical healthcare provider, to more basically pharmaceutical to more healthcare. That's what they've been trying to do, right? That's why they've been building these locations with VillageMD, and Walgreens invested $5.2 billion in VillageMD, becoming the majority owner, and said it planned to open at least 600 Village Med at Walgreens primary care and practices across the country by 2025, and over 1,000 by 2027. And the retail drugstore chain also plans to accelerate acquisitions of two other companies, which is post-acute and home care company CareCentrix and specialty pharmacy company Shields Health Solutions. How many acquisitions are you going to do? The problem is that if you can't help yourself, you can't help other people. It's the same thing in business, right? If you can't help your own business, how are you going to acquire and help other businesses? The only way you do that is from a place of strength, and Walgreens is by no means at a place of strength. They need to focus on their own core business so that they can get back up to free cash flow positivity. And of course, it's still positive. So if you come over to the cash flow section, trailing 12 months, though, it's negative, right? It's negative because operating cash flow is really low at $1.3 billion. So this is $1.3 billion in operating cash flow and massive amounts of CapEx, right? CapEx meaning capital expenditures. They're investing a lot of money and not seeing the returns and revenues and profits. That's the issue. And you can see that free cash flow, which is the light blue, has been going down. That's primarily because operating cash flow has been going down and CapEx has been increasing. And so now we have $2.17 billion as of last year. And on a trailing 12-month basis, we got negative free cash flow. This right here is CVS, right? CVS's free cash flow is $13.4 billion, trailing 12 months at $17 billion. Huge comparison, right? Dramatic comparison between free cash flow for both companies. Why? Because their operating cash flow is strong and their CapEx is decent. Their CapEx is under $3 billion. Whereas Walgreens' CapEx is also under $2.5–3 billion. The problem is their operating cash flow is struggling. So that's why their free cash flow is significantly lower compared to CVS. Of course, they're not at the same scale. And that should tell you something, right? They're not at the same scale. And CVS, with dramatically higher free cash flow and operating cash flow, is spending a lot less in CapEx versus Walgreens, which has significantly lower operating cash flow, is spending the same amount on CapEx as CVS, which is significantly higher than Walgreens. So free cash flow is the issue. It's a significant issue because the company is burning through a lot of cash on all these acquisitions, which are not yielding any returns or profits or revenue growth. This right here is the revenue growth for CVS, so very, very substantial. Again, it's a 3 times bigger company than Walgreens and $322 billion. A very nice consistent growth. Trailing 12 months also higher. Very nice profitability and gross profit operating income also going up. Now, when it comes to net debt, neither companies are good, right? They've both got net debt, $58 billion, $54 billion for CVS, although it's been coming down a little bit since 2019. Walgreens has been going up since 2019 because of all these acquisitions, and it's kind of stayed there at $34 billion. So that's where we are. Both companies have both companies have a net debt, more debt than cash on the balance sheet. Free cash flow situations far better for CVS, a lot worse than Walgreens. Lot worse for Walgreens, and that's primarily because of all the acquisitions the company's been doing. So dividend payout ratio I've already gone over. But the bottom line is I think we need to wait and see for Walgreens specifically. I think there has to be a management put in place that, once again, it's like a PayPal story, right? New management needs to come in and give the investors, give the market more insight into what the plan is. What is the plan moving forward for this company? What's the vision? What's going on with all these acquisitions? What's going on with the cash position? What's going on with the dividends? There's a lot of uncertainty around the stock, and nobody likes uncertainty, right? Especially the market. Market doesn't like uncertainty, and for that reason, we are seeing the price action that we're seeing, with this week being down over 10%, and of course last week it was down 14%. So that accelerated sell-off continues. I think $20 is going to be that next support level to watch. Now, is this worth holding, right? For me, I'm still going to hold right now, even though I am down pretty substantially on this position. I'm still going to hold on to my position only because I need to see it through. I'm already down, might as well just see it all the way through. If it doesn't work out, I will be getting out, taking my loss, learning my lesson. But bottom line is that the management needs to be appointed. Someone needs to kind of really step up and give us some guidance on what the future is going to look like for Walgreens in terms of their core business. Because their core business is still pretty good, right? Revenue, profit, as I just showed you guys, it's still pretty good. It's just all these acquisitions and it's all of these free cash flow just being burned through by a lot of the capex and operating cash flow going down. That's the main problem. That's something that need the company to become more efficient and more optimized for that. So $20 is going to be that support. Dividend cut, I'm not so sure. I can't make a call on that because it's a dividend aristocrat, so reputation is very important. Dividend investors are going to be watching that very closely. So it still has the earnings to pay the dividends. I just don't know if they're going to be cutting the dividend to optimize their profitability a little bit. I don't think they are, but you never know. So I hope you guys enjoyed this video. Wanted to do a very, very detailed and updated analysis on Walgreens. Let me know your thoughts down in the comment section below. And as always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Link to our Discord, Patreon is going to be down below. Happy investing. I'll see you all in the next video.